Hi everyone, my name is David Johnson and I appreciate you watching this video on my YouTube channel. This is going to be a short one. I'm set up outside right now at a farmer's market talking to people about mortgages, and it's a beautiful day. I really enjoy getting out and actually interacting with people face to face. But the purpose of this video is to talk to you about the current interest rate environment. The Federal Reserve, and you can watch a previous video of mine talking about how the Federal Reserves affect mortgage interest rates because of their federal funds rate. They recently raised their federal funds rate a quarter point, and that was expected. What wasn't expected was the high CPI numbers that were released on Valentines Day. Because of that, it's showing that inflation is not under control, and inflation, as we've discussed before, is one of the main concerns of the Federal Reserve, and the reasons that they raise and lower rates are to control inflation. So because the CPI data was higher than most economists and analysts expected, the prevailing wisdom is that the Federal Reserve will continue to raise their funds rate to try to control inflation. Most people that watch the mortgage industry thought that the federal funds rate would top out at 5% by the second quarter of this year, and by the third and fourth quarter it would begin to decline, which would have been very encouraging. Now, with the higher CPI data, analysts believe that instead of stopping at 5% with the federal funds rate, the Federal Reserve will probably go on up to 5.3 by the end of the year. And you can expect, as that's happening, that mortgage interest rates will also rise. Of course, interest rates are based on a particular situation, and this video isn't discussing any particular situation. It's just talking about interest rates in general and how they're affected by the recent CPI data. But I also want to give you an encouraging thought. If you are in the market to buy, it is still a buyer's market. There are not as many buyers out there as have been in the past, and that is giving you leverage with the sellers. So what I'm seeing in my local market is that people are still buying homes. We're in the spring market. It's actually picked up quite a bit, and they're not being prevented from buying because of interest rates. And one of the reasons that this is possible is because you're able to get a better deal now on a home than you would have been in the past. So even though interest rates are higher, you're going to have a higher mortgage payment more than likely than you would have a year, 2 or 3 years ago. You're going to more than likely pay less for the home. So they offset one another, and you can plan on refinancing in the future when and if interest rates do go down. Right now, ARMs, adjustable rate mortgages, are popular because the interest rates on those oftentimes are lower than fixed rates. So I'm seeing a lot of people go into ARMs now and get a lower rate with the mindset that they're going to refinance at some point in the future, 2, 3, 4, 5 years down the road when interest rates go down. So anyway, I just wanted to give you a quick update. I appreciate you watching my channel. If you would like to talk to me about your particular situation, comment below. And once again, thank you. And if you'd like to continue to receive updates like this on the mortgage industry, please become a subscriber. And I look forward to talking to you in the future. Thank you.